Welcome to Commerce GYAN. So happy to see you again in this video series. So this is our series of Basics of Accounting, and part 13 we have reached. And for final accounts, we have reached part 2. So last time we had stopped on the formats of profit and loss and balance sheet. And today we are going to continue in the journey of preparation of the final accounts. So while preparing the final accounts, there are various important things to be done before actually we go into the preparation of the profit and loss and the balance sheet. So what is that? That is exactly what we are going to understand in today's video. That when you're provided with the trial balance, is that the final thing, or there are something else, some other aspects also of the trial balance that need to be taken care of, and you have to do some entries after that, which will be useful in the preparation of the final accounts. So what are we exactly going to understand in today's video is basically what are the transactions that need to be taken into consideration, or basically what are the entries that have to be taken into consideration after the preparation of trial balance. And this is what we call as the adjustment entries, or sometimes adjusting entries. Also, since these entries are not recorded in the traditional format of journal, ledger, trial balance, and then come to the final accounts, we have these purely like a new transaction. So there will be a dual effect of these entries. So how to give that dual effect of these transactions, how to write, where to write the debit, where to write the credit, all that we're going to learn in today's video. Also, this particular video is basically crucial importance to the students of standard 11 commerce. So this is like a foundation for preparation of your final account. So before we actually proceed to the exact questions and answers and solutions of final accounts, you need to be very clear on this particular portion of the video, because this is going to occupy a large portion of your final accounts, and without this you will not be able to, you may misjudge and you will not be able to prepare the final accounts thoroughly, and it won't be a scoring part for you for that matter. For those who are wanting to take up a revision and those who are wanting to actually learn the preparation of final accounts, maybe you have forgotten it in the further journey of commerce, or maybe you just have a bridge course to complete or any of that sort. Maybe you're taken admission to commerce after 12th and now you just want to polish your knowledge. So for that, this will be really useful, and you can continue with the series and the journey with us in Commerce GYAN. So let's proceed ahead. When we are talking about adjustment entries or adjustment entries that you need to make, you need to understand two things about these. These entries are made after the trial balance. So this is something which happens after the trial balance prepared. So these are after the trial balance is prepared. And the second thing will have two effects. What does this mean? Will have two effects. That means one effect is a debit effect and the second effect is a credit effect. So just like in a journal entry, you know that there are two impacts. That means one impact is a debit impact and second impact is a credit impact. Similarly, these adjustment entries also will have two impacts. When we are posting, whenever we are doing final accounts, you'll understand that when a trial balance is given to you, you will take the trial balance item only once in either the trading account, the profit and loss account, or the balance sheet. But when it comes to adjustment entries, these are always taken two times. One may be in trading account, in profit and loss account, or in balance sheet, or wherever it is. So basically, one impact of that transaction will be a debit impact, and second impact of that transaction will be a credit impact. Now, what are the debit impacts? Let us understand. We have already learned what is debit and what is credit. What are the debits that you can have in your accounts? The debits that you can have is either an asset, or it can be an expense, or it can be a loss. Correct? Credit will be either a liability, right? Second, it can be an income. And third, it can be a profit or gain. This is what we have learned till date. So whenever you're giving the adjustment entry impacts, if it is like one side asset, it may be any of these on the other side. Okay. So one impact will be either it's an asset, expense or loss. And second impact will be it was either a liability, income or profit. Got it? So this is how we will make the adjustment entries. Now, what is adjustment entries and why adjustment entries are needed? Okay. First thing is when you prepare the trial balance, after preparation of trial balance, you may realize certain things. So after preparing trial balance, let's say you come up with an electricity bill. So somebody hands over an electricity bill that is unpaid. That's unpaid. See, now when you are using electricity for the month of March, okay, when are you going to make the payment of that electricity bill? Do you make it in the month of March itself or you make it in the next month? The answer is you will make it in the month of April. So if electricity bill is for the month of March 2024, it will be paid in the month of April 2024. Now, our accounting period concept says that whatever are the incomes for a particular financial year or whatever are the expenses of that financial year should be recorded in the same financial period. So the accounting period will start from April and will end on March. And whatever incomes and whatever expenditures fall in this time period should be considered. So if I'm talking about electricity bill, now I haven't received an electricity bill. Maybe I received the month for the month of March and electricity bill is received in the month of April. Let's say 8th of April or 5th of April in my hands. But by 5th of April, my accounts have already closed because 31st March was the last date of closure. So on 31st of March, I'm going to assume a certain figure that, okay, on an average, my electricity bill comes to 10,000. So I will make a provision for that electricity bill. Okay, so when I make a provision of that electricity bill, now it's not paid, right? It is still not payable because electricity bill has not been received, right? So in that case, what do I do? It will be considered as an adjusting entry showing that yes, an expense is payable in the books of accounts, but it is still not paid. So how do I take it? I will have to take it as an expense also because it relates to that accounting period. And second, I will also have to show it as unpaid. It will be treated as a liability when I am taking that adjustment entry. Got it? So one by one, now we will consider the adjustment entries, what will be coming up in the preparation of final accounts. And when we actually do the questions on final accounts, it will be crystal clear to you how these are used. But right now, this entire video is completely dedicated to the adjustment entries. What are the two impacts of each adjustment entry we are going to understand. Got it? So pay attention carefully to the entire part of this video. Now, the first adjustment entry that we are going to learn is relating to closing stock. Now, what do you understand by stock? First of all, stock is something which is like an inventory in hand. Now, at the end of the accounting period, what is the accounting period? The accounting period will end on 31st of March 2022, whatever the period is. So on 31st of March, I realized that there is some stock which is unsold. So when that stock is unsold, what happens? I will have to take into consideration this stock as a part of unused stock. It is a part of my asset. It is still carried forward to the next period. So it will be considered in one impact as an asset. Correct? And the second impact is when already I had made a purchase, I showed purchases as expense, if you remember. So when I show purchases as expense, I cannot consider this part of the purchase as the expense because it is going to be carried forward to the next year. Correct? So in that case, this particular stock will be reduced from expense or shown on the income side of my trading account, because stock is shown in trading account. So one impact is the debit impact, which is showing as asset, and second impact I'm showing on the credit side of the trading account. So whenever I have a closing stock entry given in the final accounts, what I'm going to do is one thing, I'm going to put it on the credit side of the trading account as a part of income, because it is actually a reversal of my expenditure for that year. And second, this amount is also going to be carried forward in the next accounting year as an asset. So I will show this in the asset side of balance sheet. Okay, these are the two impacts of closing stock. Hope this is understood clearly. Now, second type of adjustment entry will be related to depreciation. Now, we had a separate video which was prepared for depreciation. If you haven't gone through it, please go through. It is there in this particular series of basics of accounting. The playlist will have the depreciation video. So you can go through what is depreciation and everything in that. Now, for depreciation is basically, we say it's a reduction in the value of the asset. So when I say reduction in the value of the asset, it has to be reduced from the asset, right? When it is reduced from the asset, it is having a credit impact. Fine, because it is reduced from asset in the balance sheet. And this impact is a credit impact. Why is it a credit impact? Because assets have a debit balance. When I say less from that asset, it will have a credit impact, opposite impact. Got it? So reduction from the asset will be a credit impact of depreciation. Now, what is the debit impact of it? Because we are doing double effects, right? Adjustment entries will have two impacts. So what are the two impacts? The second impact will be, this is our first impact. Second impact will be show under expense. Show under expense in which account? Now, this is not a direct expense, so it will go in the profit and loss account. And this impact of the adjustment entry will be a debit impact. Correct? So one is you will reduce it from the asset in the balance sheet. So if my balance sheet shows furniture account, let's say furniture is 10,000 and I have a depreciation of 10%. I will say depreciation 10% minus, so 1,000, and in the outer column, I will show 9,000 as the value of the asset. So this is how you will show depreciation, and this 1,000 of depreciation will be taken to profit and loss account also. So it's not only one, right? Two impacts. One, I'm taking to the furniture. I'm reducing it from the furniture because now the asset value has reduced. And this amount of reduction is again taken. It's actually an expenditure for that time period. So it goes in the profit and loss account expense side. Fine. So these are the two impacts of depreciation. The third type of adjustment entry is prepaid expense. Prepaid expense. Now, when I say expense, where do you show expense generally? We will show the expense as a debit impact, the debit side of either trading account or profit and loss account, correct? Now, when I show a particular expense, suppose I say, let's say advertisement. When I say advertisement is, let's say 1 lakh rupees. This will go into the profit and loss account debit side. Now, if I tell you that of this 1 lakh rupees, which I paid in the financial year 22-23, an amount of, let's say 5,000 relates to the next year, relates to the year 23-24. So can I show this entire 1 lakh rupees in the year 22-23? No, it will be wrong, because 95,000 only was the expenditure related to this accounting period 22-23. So for 22-23, how much should I show? Only 95,000. Of course, I paid 5,000 in the same year, but this 5,000 is not used in the year 22-23. So when is it going to be used? It is going to be used in 23-24. So I have to reduce it from my expense. So first impact I am doing of this prepaid expense is reduced from the respective expense. Whatever expense it could be. It could be electricity bill prepaid, then it could be advertisement prepaid, repairs prepaid, whatever. So if you have paid some expense which does not relate to that financial year, that accounting year, then what you should do? You should reduce it in the respective expense head, and this will be your credit impact. Got it? Because expense has a debit and you're reducing from expense. So it is the reverse impact and it will be a credit impact. Second, what is the second effect that you give of this prepaid expense? Now, expense paid in advance. You are to receive the service against it. So for you, it is acting as an asset till the time the service or that product comes to you. So prepaid expenses, if you remember the balance sheet format, it is shown in the asset side of the balance sheet. So second impact is show as current asset because it's a short-term asset, right? Current asset in balance sheet. And this assets obviously will have a debit balance. So debit impact is taken care of here. So you find here one is credit impact and second one is the debit impact. Got it? Next. Now after prepaid expenses, next type of expense, fourth one that we have is outstanding expense. Now outstanding expenses, what are outstanding? Outstanding doesn't mean that you are doing such a great job or something. That's why I say, okay, outstanding student. No, this is not that outstanding. Outstanding here means it's unpaid. Okay, so the meaning of outstanding here is unpaid expenses. Got it? So if you had some expense, but you didn't pay in that year. So I say, okay, there was some interest payable, suppose. Interest unpaid. I'm writing for the year 22-23 and I say that for this year I was supposed to pay interest of 1000 but it's not paid. So interest is payable but is not paid. In that case, there should be one important impact which I consider this as expense because it is related to that financial year. It's not for next financial year or previous financial year. That expenditure which was unpaid is related to that financial year which I'm preparing. So first impact that I give is show under expense, okay, in either trading or profit and loss account. Trading or profit and loss account. This is your debit impact because you're showing as expense. So debit impact is taken care of. So basically when you're showing it as expense, expense is related to that financial year, remember, but is not paid. So it is something which is like a payable. If you remember, the second impact has to be given. So payables, what do payables mean for accounting? Payables means a liability and liabilities have a credit balance. Where are liabilities shown? Liabilities are shown in balance sheet. So this outstanding expense will be shown as an outstanding or as a payable in balance sheet liability side. And this impact is the credit impact of that particular expense. So basically outstanding expenses will have two impacts. First impact will be show it under the expense. It could be trading account expense or it could be a profit and loss expense. And second impact of this has to go to the balance sheet liabilities. And of course, this liability side will be the current liabilities. It's a short term. So under current liability, you will show the outstanding expense. Got it? Next fifth one that we have after outstanding expenses. We did prepaid expense, we did outstanding expense. Next is related to income. Now, if it is prepaid income, just like expense, income also can accrue to us, can be got by us in advance. It's not related to this year, but you have still got the advance. The person said, okay, fine, I will pay you for this entire 12 months time period, plus I pay you extra 1 month for the next month. Then what? Or rent. Rent, person has not used your premises, but is paid in advance. Always rent is paid in advance for the next upcoming month. So what we do here, prepaid income. So if the person receives, or rather your organization for whom you're doing the accounting receives income in advance, it is not your income for that financial year or that time period. So it should be taken to the next accounting period. So how do you do that? You will have to reduce this particular income from the income head. Reduce this income from whatever head you have in trading or profit and loss account, right? Trading account or profit and loss account. And this impact, reducing the income, will be the debit impact. And now when you have taken the money in advance but have not given the service or not given the goods, then is that amount a liability for you till you render the service or you give the goods? The answer is yes, because if tomorrow I default in giving the goods which were agreed upon, I will have to refund the money. So this money for me becomes a liability till the time I provide the service or I give the goods. So second impact of prepaid income will be considered as a part of liability, current liability in balance sheet. Okay, this is a current liability. This will be your credit impact. Fine. So prepaid income you have understood. Next one is your outstanding income. Now again, this outstanding is which outstanding? Not received, right? Outstanding in this case will be not received. Income not received yet, but it's due, right? You should have received it, but you haven't received it. Then in that case, what to do? This is income actually for the accounting year. So if you were supposed to receive income of rupees 10,000, but have not received it, then what to do? Then in that case, so suppose you were to receive an income of rupees 10,000 and you haven't received. So you should consider that income in the trading or profit and loss account, whatever is applicable. So what you do, first impact you give is add this income, add, or you can say show this income in your trading account or your profit and loss account, whatever the case is. And this will be your credit impact because incomes have credit balance, right? Credit impact. Second one is when you're talking about the uh, credit impact, now the debit impact of this outstanding income, what should you give? Outstanding income which is actually, you can say, not received. It should be received, but it's not received. So can we consider that as an asset? The answer is yes, because you gave a service, but you haven't received the benefits of that service in the format of income. So what you do? You will take this as the part of current asset in balance sheet. This is a receivable. In short, you can say this is a receivable asset. Correct? So if you're saying it's outstanding income, it is an asset. It's a receivable. And if you say outstanding expense, it is a payable, and payables is a liability. Liability is shown in balance sheet, liability side. Got it? So in this way, it will be simple for you to understand. Prepaid income uh, received in advance. It is a payable till the time you render the service. Income which is Prepaid income is a different story. Income which is outstanding means it is an asset receivable, and at the same time, you can take that as part of your own income in the current year. Got it? The next three of them are connected to your debtors. Okay, we are going to talk about bad debts now. Do you remember the debtors? What are debtors? Debtors are basically connected to your sales, the credit sales. Okay, so to explain bad debts, first let us understand term debtors. Again, we are revising it. Of course, we have done it earlier, but I'm just revising it for a quick review. Debtors is your trade receivables, or in other words, I could say that this is sales on credit. People who are supposed to make the payment to you for sales but haven't paid you yet. These are your debtors. Loans advances are not debtors. Okay. Even if you gave a loan to someone and it's receivable, it is not a debtor. Debtor is only against the credit sales. Sales could be of goods, sales could be of service, but it is credit sales. Fine. That is first part. Now debtors are grouped, right? We say there are good debtors who will pay you. There could be doubtful debtors. Okay, it's a doubt like, okay, I gave that person credit, but he may or may not pay. तो उसका हालत कुछ खराब है. So they may not have that proper solvency. They don't have the money. So क्या होता है? They may not pay you. So in that case, that amount becomes doubtful. So when you say doubtful debts, then the question is, should I consider then all these debtors as receivable? The answer is no. There will be some issues, right? So then how to provide for it and how to actually create that particular provision for the loss. That's what we're going to see here. And third type of debtors could be those which turn out to be bad. Then maybe the person has run away, not traceable, correct? So in that case, these debts become bad debts. So how to treat these bad debts in your books of accounts in the format of adjustment entries? This is what we are seeing now. Got it? So this part is clear to you. Now let's see how to give the effect of bad debts. Suppose take an example. There is Mr. Kumar who was supposed to, he's a debtor, let's say, okay, and he was supposed to make a payment to you of 1 lakh rupees. Now, he hasn't paid the amount of, let's say, he paid 80,000. So, paid amount from Mr. Kumar is 80,000. Outstanding amount is 20,000. Now, of this, you realize that this person has become insolvent. So, Mr. Kumar became insolvent. Do you remember the journal entries we did of insolvency? Part amount is received, part amount is irrecoverable. So, we put it under bad debts, correct? So, those are bad debts which we took into consideration already in the year. But what if at the end of the year, I realize, there is somebody who is still to make a payment but will not pay, default ho gaya. So in that case, I have to take that into consideration. So इसमें से 20,000 from this, I need to reduce the amount of bad debts, isn't it? To know what actually I'm going to get in hand. If they say that, okay, bad debts would be 5,000, 15,000 only will be recoverable. So this 5,000 is my loss, correct? Bad debt loss. So how do I do it? I will take the bad debt loss. Show this in the profit and loss account. This will be your debit impact. Correct. And secondly, bad debts are irrecoverable debtors. So as I have shown here, the amount is receivable is 20,000. From this 5,000 is bad debts. So actual debtor for me, Mr. Kumar, will be only 15,000. So what do I expect to recover from him is only 15,000, correct? So that is the reason I will have to show a reduction from my debtors. Okay, so reduce amount from debtors. Reduce the amount equivalent to bad debts from debtors. This will be your credit impact. Why credit impact? Because debtors have debit balance and I'm going to reduce that balance. So when I'm reducing the debit balance, automatic impact is a credit impact, correct? Opposite impact. So that is where you have bad debts. Now that is one thing which happens in the case of debtors. Now what if I say, let's take the next part, next portion of adjustment entries is connected to provision for bad debts. Or you could say RBDD, where we say reserve for bad and doubtful debts. Okay, RBDD. This is considered as reserve for bad and doubtful debts. Now, when I'm saying RBDD, this is creating a reserve. Reserve means what? Basically keeping aside some money. Why do you keep aside some money? Now you take your own example. You are planning for a picnic or something, and the picnic is scheduled for after, let's say, 3 months. And you know that I need 30,000 for the picnic. So what do? Every month you start saving. You say, okay, every month I have to keep aside 10,000, 10,000, 10,000, so that at the end of the third month, I will have 30,000 in hand to go for the picnic. So this is what you're doing is you're creating a reserve, you're creating a provision for the purpose of your picnic. The same way, if I doubt that I will incur a loss or there will be some extra expenditure, what do? I make a provision. This is what is this RBDD on your debtors, reserve for bad and doubtful debts. So basically, I will have to create a reserve for the debts that will prove to be bad. Probability is that they will prove to be bad. So what do? I create a reserve. How do I create a reserve? I first reduce that amount from debtors. So what impact is this? You tell me now. This will be a credit impact. Got it? Fine. And what about the debit impact then? The debit impact, of course, this is a provision, this is a reserve. And from my profits, I have to take away this money, right? So against my profit, what is the opposite of profit? I have to create a reserve in the format of expenditure side. So on the expenditure side, I will reduce that. I will show that amount on expense side. Show RBDD in profit and loss account debit side. In profit and loss debit side. So this is your debit impact of your reserve for bad and doubtful debts. So hopefully this is clear till here. And finally, you could have, okay, for the debtors, you could also have discount on debtors. Now you know that there will be good debtors, but you want to encourage them to make a payment in the coming time period. So for whatever debtors in hand you have at the year end, you decide that, okay, I will give them some 1% discount when they make the payment. So that 1% discount is kind of an expenditure for your organization, and that much amount is going to be received less from your debtors. Agreed? So what I do, I will show one impact of discount on debtors, show discount on debtors on expense side of profit and loss. And second is basically you will have to take this discount, reduce it from your debtors. From debtors in balance sheet. Got it? So we have basically three things. One is your bad debts, right? When you're talking about debtors, you have bad debts. Second, you have reserve for bad and doubtful debts. And third is reserve for discount or discount on debtors. So now what if the question says that you have some bad debts, you have some reserve for bad and doubtful debts to be created, and you also have some discount to be given to debtors? What should you take first when you're creating the impact? The answer will be you take first, reduce from your debtors the bad debts. because we don't need to create any RBDD on actual bad debts, correct? If already there is a loss, you don't have to, you know that it is a loss. You don't have to create a reserve for that loss any longer. So after reducing debtors, after reducing bad debts from your debtors, whatever remains on this amount, you will then create a reserve for bad and doubtful debts. That much will be maybe a loss for you, right? So this amount will not be recoverable. So then you reduce your RBDD. And then after that, what amount remains on this, you provide a discount. So what is the step? First step is bad debt. Second step is RBDD. And third step will be your discount. Don't miss this sequence. Fine. So first, understand the logic. First, you have to reduce the losses. Bad debt loss, reduce it. Then what is left in hand? Whatever is left in hand, on that you create a reserve for discounts. And after that, after you create the reserve for discount, reserve for bad and doubtful debts, then whatever remains in hand, you will create a reserve for discount. So first bad debts, then reserve for bad and doubtful debts, and third will be the reserve for discount. So you don't provide discount on losses, right? If somebody is not going to pay you, why would you give them a discount? Correct? So first, loss ko bhaga do, then create some provision for losses that may happen, and then whatever remains is a recoverable amount, good people who will pay you, and for them you give an incentive in the format of discount. Clear? Remember this thoroughly so that you can understand how you can solve the problems. Next, which we are going to consider is the eighth one, which we are considering as the discount on creditors. What are creditors? Creditors are basically our purchase payable. So if you remember, we had purchases made on credit, and we may sometimes receive a discount from our creditors. So when we have to when we get a discount on creditors, we have to pay them less. Correct? So first impact that you do is reduce this amount from creditors. Reduce amount from creditors. And this will be your debit impact, because creditors have credit balance. So when we reduce from creditors, it will have a debit impact. So why we are reducing it from creditors? Because utna amount humko kam dena hai. We have to pay them less, right? With this particular amount. So if I say 5,000 is your discount on creditors, this much 5,000 amount you're going to pay less to the people. Got it? Second impact. Now this is acting as if it's going to be your income, right? You're going to enjoy the benefits of this discount. So when it is a benefit, it will go as a indirect income in the profit and loss account. Show as indirect income in profit and loss account. So this will become your credit impact. Got it? So discount on creditors. Then, so after discount on creditors, what we are supposed to learn is basically entry for drawings by proprietor. Drawings by the proprietor, by owner or proprietor, right? What is the impact of drawings? Drawings is a withdrawal of your capital. So one impact will be reduced from your capital. That's very clear, right? Drawings are a withdrawal of capital. So reduce from capital. Fine. This is your debit impact because capital has credit balance. So when I'm reducing, it is a debit impact. And secondly, reduce from whatever expense that you have. From expense that you have. So this will be your credit impact. Because reducing from expense, matlab advertisement, if you have paid on behalf of your proprietor, that much amount of advertisement is less for your business because that is not your business expense. So if 5,000 was paid in all, and of this 1,000 is paid for your proprietor, that 1,000 will be reduced from expense because it's not business expense. Got it? So that reduction creates a credit impact. Okay, so these are the basic adjustment entries that you're supposed to do, and all adjustment entries will have, remember, two impacts in the either the trading profit and loss account or balance sheet, or both will be in balance sheet, both will be in trading account. You never know. So one important thing you have to remember is one impact is debit impact, second impact is credit impact. Now, right now in this video, by the end of this video, this is enough learning that you have understood the concept that adjustment entries are to be made when you're preparing final accounts. And second important thing that you are supposed to keep in mind is that they will have two impacts. Now, rest of the things we will be, of course, learning in the upcoming videos. So this is how adjusting entries are done after the trial balance is actually taken into account. And after that, you will make these adjusting entries. You may have a journal proper in which you write the adjusting entries and give the effects directly into the trading profit and loss and balance sheet. You don't need to go via the process of journal, ledger, trial balance, and so on. So this is a direct, you can say, approach when you're preparing the final accounts. So this is one of the parts of the final account series. So in the third part of a series of final accounts, or in part 14 of basics of accounting, we are going to learn about the actual preparation of final accounts. So stay tuned, because that will be a very important part of your entire accounting syllabus, because final accounts is something which is very interesting also, and at the same time very crucial, very important for your future also, because this is something which you cannot afford to forget for your lifetime. So hope to see you in the next part of the video, and you will learn the final accounts preparation. Thank you.